Welcome back to the Weekly Juice Podcast. As always, Ryan and Cory here. Today we're going to be bringing you another one of our educational episodes, and this episode specifically is going to go into financing your rental property empire. We're going to talk a lot of different types of lending and kind of walk through a few scenarios. So without further ado, Ryan and Cory.
It's just us today.
Just us.
That's cool though, because I think like as we're still in our first 20 episodes, so like the early ones people will be able to look back and go to, managing tenants and finding and funding deals or financing deals, analyzing deals. It'll be good for people to be able to go back, and it's kind of just our opinions on how we see things, but also some just like maybe industry standards and just overall educational tools for people.
Yeah, so. And I think there's terms that people want to revert back to these episodes so that way they understand future episodes when we have some of the heavy hitters come in that have a ton of rentals.
Yeah. The good thing about this is you don't have to listen to our episodes really in any order. Like if you wanted to know about funding deals, maybe listen to this one and then go back an episode and listen to Stealthy Rich, because Chris was incredible and some of the tools here might help you understand that episode better. I mean, that's the way I see it. You 100%. Can listen to these in any order, especially because we have a lot of personal finance. There's no succession to it. So cool. It's good.
Sweet. So let's talk funding deals or financing your rental property deals. So there's a bunch of different ways you can essentially finance these deals. And people, I think, oftentimes think they have to get a 30-year mortgage and that's it. And they have to go to the banks and, pass credit scores, all that stuff, and hopefully obtain a mortgage. And they're not sure how much that will be. So we're going to talk about all the different avenues that are out there that we know of today. Yeah. And we'll go into each one. So I think
just a caveat though, like we're not experts on this. So like we do know we're starting to build, we're starting to get really educated on it, I would say, but like there's probably things that go on here that there's all types of creative ways to finance deals that we don't even know about, So like we'll touch on the basics, and then I'd like people to reach out to us and be like, yo, I did it this way. This is one of the creative strategies I use to fund a deal. Like that's great because we don't know it all.
Yeah, it won't be super, super top level, but we're not going to go in depth and give scenarios every single one. Put it that way, right? Exactly. So let's talk one of the most common ways to finance a deal, all cash, right? So most of our listeners know about Bigger Pockets. So Bigger Pockets and Memphis Invest conducted a nationwide survey back in 2012 and found that 24% of all U.S. real estate investors used cash only to finance their deals.
I didn't know that. And that's interesting because what it's telling you is that, in my estimation, it's happening with very experienced investors, right? When you're just starting out, if you have $200,000 of cash or $100,000 of cash to buy a property, it's just hard to obtain that. It goes back to your savings rate. Maybe you invested in something that blew up. That's really great. You can pull it out and invest in real estate. But all cash it's a really, really safe route, and somebody like Dave Ramsey would say, like, that's the way to do it. Personally, we're not at a stage where we feel like we can use all cash unless we're at a really low price point in the market, right? Mm-hmm. So certain market segments, we talked about Cleveland, we talked about Columbus, maybe something out there, you can get something for,
$30,000,
yeah,
put 15 each.
Exactly. You could do that, but in the Philadelphia market, Jersey market, for me, it doesn't make sense to put that much of my money into something because the return isn't as good. But talk about safe investing, right? Like my ideal would be to have a couple paid off properties where it's a little bit safer, a couple leveraged at 50%, a couple leveraged at 25%, but all cash is
you touched on a couple different camps here, right? Yeah. So you have the no debt camp and the leverage camp, right? So the no debt people essentially would be like Ramsey.
Yeah.
People should invest only in rental properties if they can make all cash for the deal, and 100% of the foreclosures, just so you know, basically 100% of the foreclosures that happen are people that have loans. It doesn't really happen to the people. How could it happen to the people that pay it all off?
If you default on taxes, but that's really it. I mean, yeah, you're totally right. And the funny thing about that with Ramsey is there's that side that's no debt, and then there's the other side. I'm not sure where Grant Cardone stands, but I know a lot of people that are look, leverage your money as fast as you can, pull it out of a deal so you can go make 15% more or 20% more, go pull money and keep leveraging it. And like a lot of people will say, go $10 million in debt. If you're $10 million in debt and you're bringing in $20 million a year, like you're $10 million in the plus, right?
Some people say, why real estate if you're not going to use the leverage?
Yeah,
you know
exactly.
what I mean?
That's how I kind of think for us it'd be a good blend. But starting out, it's just tough to go in all cash. But there are people you'll find on both ends of the spectrum. And my advice for people is just to like find out where your like risk tolerance level is, right? Like that's another thing that I wanted to touch on with like 2008 when you talk about all cash or like leverage. What was happening in 2008 or just before in 2007 is that banks were handing out money to people that were putting like essentially $0 down on an investment property. And because there was just so much money to go around. And that's not, I'm not saying I know why the stock market crashed and that happened, but what I'm saying is that they were handing out all these loans. People were so over leveraged, and then when the market dropped 30%, every single person was underwater on their loans. So that's why there's rules in play now with financing where on a home, a single family home, if you're an investor, you have to put 20% down. If you're buying a small multifamily, you have to put 25% down if you're not doing all cash.
Right.
So, and I think it's smart. I wouldn't want to put, you're putting your equity into the property. I wouldn't want to really get a rental property, an investment property for 5% down, because what if it drops down by 30%, So
100%. So just a caveat and to explain, a lot of people when we say all cash, it doesn't mean cash is actually being traded. In most cases,
like physical dollar bills,
right? In most cases, the buyer is bringing a check, such as a cashier's check, to the title company, and then the title company is going to write a check to the seller. You can use a wire transfer as well, but it's not physically like presidential trading cards. Here we go.
No, but the point is you just don't have to. You're not taking out a loan.
Exactly.
And you're not financing the property.
Right.
So.
And bring it back to your point, I think of take a $100,000 deal. You can buy, say you have $100,000 in cash, and you say, okay, I'm going to buy one rental property.
And by the way, we're not saying that like people have that lying around, but I don't think a lot of people do. But if you do, yeah.
If you do, just you could spitball numbers 50-50, but let's just go 100 grand for sake of the argument. Yeah. And you have 100 grand, and you decide to buy one rental property. Cool, you're done, free and clear. Or on the other hand, you could buy 5 rental properties with $20,000 down on each. It just depends what camp you'd rather be in.
Yeah.
We're talking Ramsey, we talked Cardone.
Well, here one case is you're probably making a lot more cash flow on one property, whereas if you buy 5, you're having a bunch of different buckets of avenues. You're kind of dispersing your income, so to speak. Maybe you have different tenant types, like we talked about, like diversifying your portfolio within that aspect, and then now you're able to go buy more because you have different buckets adding more money to your pool. So I think it's just all about each person's tolerance. It's hard to say what's right. But for me, I would want to get 5.
Right.
As opposed to getting 1.
That's how I feel too, so maybe that's why we're good partners here. But I'd say a couple tips and just tidbits here on all cash. You have a huge amount of leverage if you go into a deal in closing with all cash, rather than say you and I go in to buy a property and we want to buy it for 160 grand and someone else will say, okay, I'll buy it for 160 grand. I'm going to pay all cash. The seller goes, okay, Cory and Ryan, what are you going to do? We're going to finance it conventionally. And then they'd say, okay, I'll go with the guy with all cash because they know it's a sure thing. So it gives the buyer a lot of leverage. But on the other hand, it's interesting because people try to sue people that they know have money. So essentially not a lot of people, but you tend to buy from, or what I've read is you tend to buy from an LLC with all cash because you want to hide the ownership of the property. Basically, like Corey Jacobson goes in, he has 100 grand. The buyer knows you have 100 grand, and if they want to come at you directly for that, as opposed to going through your LLC, which
is protected. Yeah, exactly.
So that's interesting play on that too, and that goes into that dives into a previous episode. But there's so many different things with cash only.
Yeah, I don't know if we're just not in a position where we can speak too much on buying with cash. It'd be cool to bring somebody on who has done like all cash deals, because you're right, to the seller, that's what they want. They want somebody to come to offer them all cash. It's cleaner, it's easier, they get it done quicker. Don't have to deal with banks and stuff. So
yeah, I think just be careful when you analyze your deals. If you know you have the cash, don't skimp out. Pretend you're going to get a loan in a way, because then you don't basically you go for a deal that might not actually be a deal because you're like, I can just wipe it out in one shot. So
yeah, it all depends on like how much you feel like you're going to get back in return. For us, the reason that we like real estate is because we know we can get an 8 to 10% return in the stock market. If we can get 15 to 20 in real estate, then we're going to say, why wouldn't we put our money in that asset that pays us in so many different ways with the appreciation, the tax savings, the loan pay down, and the cash flow? That's the whole point of taking $25,000 or $50,000 and putting it into a deal like that, as opposed to just saying, here, I'll put it in the stock market and make 8 to 10%. So point is, what we're saying is that if we had $100,000, we'd probably buy multiple properties leveraged at 20 or 25%.
Yep.
Yeah.
And we said that's going to, that could change for everybody. But
yeah.
So we talked all cash. The next bucket I want to dive into is conventional loans, which this is the most common, what people probably are most familiar with. But essentially this is the standard loan that you might obtain from a local bank, credit union, or mortgage lender. And with rental properties, when you're getting a conventional loan, you'll need to come up with a sizable down payment. We talked about this between 20 and 30%.
Yep, it depends.
So your primary residence.
If you're buying a single family, right now, most or almost all banks will require, and mortgage companies will require 20% down. There are some ways that you can do a 203K loan in which you put 15% down and finance a rehab in that. I don't know a lot about that, to be honest with you, but most single family homes, you have to put 20% down. In most multifamily homes, meaning 2 to 4 units, you have to put 25% down. That is like the minimum from these banks. Mm-hmm. And then anything over 4 units is treated as a commercial loan, in which I don't know if you need to go 30-year financing or 20-year financing, but oftentimes you have to put a different percentage down. And that's actually something I've never dealt with. But I know that if it's more than a 4-unit building, you're in commercial lending. You're no longer in residential lending.
Mm-hmm. So in this, essentially when a lender creates a mortgage for you, it's likely that they'll sell the loan. So the primary job of most lenders is to use a bunch of mortgages and package them together and sell the package so that the lenders get their money back. And the likely buyers of these loan packages are 2 government-sponsored enterprises that people have probably heard a lot about, and I just, I never really knew the exact nickname for them, but the enterprises are called Fannie Mae and Freddie Mac. Yeah. And those are the nicknames given to the Federal National Mortgage Association, Fannie Mae, and the Federal Home Loan Mortgage Association, Freddie Mac. So like any other mortgage buyer, essentially these associations want to know exactly what they're getting into, and they have requirements on what they will or will not buy based on. So think about loan amount ranges, borrowing credit, credit score minimums, and then the loan to value.
Yep. And a lot of times Fannie Mae and Freddie Mac are used in not only conventional, but like owner occupancy financing deals where you can put less than 20% down. So we talked about as an investment property, but if you want to buy a property and house hack, so to speak, which is, in my opinion, the single best way to get started in real estate investing. Like there's other ways to do it, but in my opinion, that's the best way. And what you can do is you can buy a property. We talked about this in previous episodes. Put less than 20% down, put 10% down, put 5% down, as low as 3.5% down. Live in the property, have roommates pay your mortgage, and then when you move out, you don't have to refinance the deal. You can then use it as an investment property. It doesn't work on every property, but if you want to get started house hacking so you don't have to save up that $25,000, $30,000, $40,000. You can save up $10,000 or $5,000 and get into a property, and then get your start that way.
I think to go against contrary to popular belief, you don't have to be like right out of school or just want to live with roommates because you're at a young age. There's a lot of people that are in their mid-30s and 40s that will house hack.
Yeah.
David Green, today's episode, on Bigger Pockets.
He's like, he's going to house hack this next one.
Yeah.
He's single, which is great. It works out for him. But like house hacking is a bunch of different things. A lot of people think of it as like, I have to buy a duplex and live in one unit and then rent out the other unit. That's the best way to do it. Maybe if you have like a family and you don't want to intermingle. But if you have a 3-bed, 2-bath, like that's what I do, and I have roommates, and each person lives in each room, and it's 2 bathrooms, so two of my roommates share a bathroom. But like, or you get buy a 4-bed, 3-bath, like, and then that way, if you buy a 4-bed, 3-bath, you even have more people that are renting out your space, and probably you're making more money off of it, breaking even, or even making money off of it. So, or you could buy a 4-plex and rent out 3 of the other units. I bet you'd make money.
Oh yeah, you would.
You know what I mean?
My God,
So
there's a lot of ways to get creative with it, and I think it's an insane idea, especially for people starting out.
Yeah.
But
talking about, stick on the actual funding of it. I mean, the strategy thing that we can
we
talk
were going to
forever
touch
about
on.
that.
I was going to touch on house hacking at the end, so
Okay,
you just covered that, which is great. So let's get into the conventional lending process. There's 7 steps to it, and I think it's easy to go in and explain what it actually is, but to follow the roadmap will help people out a lot. And maybe we'll make a post about this too, just to like have the roadmap. But
like obtaining a loan, you're saying?
Just going through the whole process. Yeah, exactly. So step 1 is essentially shopping around and building relationships, right? Like the bank needs to approve both you and the deal before they'll lend. So a lot of people start with the bank they already have a primary checking account with. Schedule an appointment with a loan officer and sit down and talk with them about your goals in person, what you're looking to do.
That's the easiest way, right? For sure, to go to like I have a loan with Citizens Bank. But then after you realize that, some of and they were talking about this on Bigger Pockets the other day, where like some banks are better for real estate deals. Some banks are better for checking accounts. Some banks are better for credit cards.
100%.
Like that's kind of how it is. Whereas Wells Fargo, there was a statistic the other day, like most of Wells Fargo's assets is in real estate. So they're one of those banks that are good, but also smaller local branches are like, they're more willing to lend the smaller investors money. So but you said building relationships. Like how many lenders could you call right now? I probably know three.
3 or 4.
And like just to have that, like, and by the way, if you have a good lender, they'll say, you know what, Cory, I might not be able to get you what you need on this loan. How about you call my guy or my girl over at this company?
Right.
And that way, that's how you build the relationship. All you have to do is start by calling.
It's basically you start with the one that you have your primary checking with just to get comfortable.
Yeah,
because
exactly.
essentially what you're going to do, as you mentioned, is have a conversation with 3 to 5 other lenders.
Yeah.
You're going to want to compare, right?
Yep.
What packages can you offer? What loan amounts you typically lend on? What are your rates? How long's the term? And then get one that you're comfortable with, and then get pre-qualified.
Yeah. Pre-approved, right?
Pre-approval.
Yeah.
Yep. So essentially, that's step 2. So I jumped in a little bit, but step 2 is pre-approval. So getting pre-approved and pre-qualified is essentially getting a conditional yes. Like, yes, we will lend to you, even before you bring the deal to them. You basically are just saying, here's my credit score, here's my background, here's my W-2, all that information.
Tax return.
Yep. And then they'll, one of them will pre-approve you.
They measure your debt to income ratio, essentially, is what they're doing. Is they're saying, like, how much do you make? What loans do you currently have out? Like, how much do you owe? And then they'll pre-approve you up to a certain amount of homes, so to speak. But to go off this, and this is one of the important things that I'll say, when you're shopping, there's a big difference between somebody who's buying an investment property and somebody who's shopping for their forever home, right? Or their dream
100%.
home, you know what I mean? And
yeah.
like, I have opinions about that I'm not necessarily going to go down that rabbit hole because but my point is, and I'll share a little bit here, is that you will get pre-approved by lenders for potentially a lot more than you should buy for, right? Like, and that's one of the biggest things. It's like, did you know, this is a stat I read the other day, is that if you and a spouse make $200,000 combined, you will get pre-approved for $1 million home. And that's fucking scary. Because
dude,
that straps you so tightly to that, and then you're literally house poor. And I'm not saying who makes what and how to spend your money, but I'm just saying that it's crazy that you can get approved for 5 times your salary combined. And
it's mind-blowing.
It's crazy.
When we talk budgeting, we've talked about this in previous episodes too. 1/3 of your monthly income should be geared towards housing. Not more than that. I mean, everyone's different.
I think less, but agreed. That's a great rule of thumb. Yeah, it is. Exactly. So,
imagine $200,000 and you're okay. Yeah, you're ready for $1 million. Imagine that
your
mortgage.
Mortgage is like, I don't know this off the top of my head. We could probably look it up.
Probably
like
wouldn't have enough
$7,000.
Yeah, something crazy. You probably wouldn't have enough to eat.
Yeah, but here's the thing, that people get involved with that and they love the finishes and I'm not telling anyone how to live their life. I'm just saying that when you get pre-approved, they're going to give you up to as much as you can offer because they're not budgeting shit for you. They're not their job. It's not their job to tell you how much to spend. So just be cognizant of how much you feel like you should spend. Because if you have a really good job, let's say you do make $100,000 a year, somebody listening.
And a great credit score.
And a great credit score. You're going to get approved for a $500,000 loan, and then you're going to think, oh, that's what I should buy. And it's like, hold on. Pump the brakes because you might be able to buy 3 houses for $150,000.
I'll tell you what, if you have a good lender that's willing to teach I have, ours
Yeah.
right now, he's phenomenal. He told me, he's like, Rye, I can get you approved for way more than this.
Yeah.
Way more.
Yeah.
And he's like,
And
I just don't want to do that because then you're going to think that you can afford this. And, say something happens with your job or say something, you have a life change. Do you really want to be stuck with this huge ass loan?
So go back, listen to Lauren Williams' episode. She talks about budgeting, talk about how much you should spend on your housing, and then just get educated on it so that when you call a lender, the problem is you have the potential to speak with somebody who could try to screw you over. So you want to call someone, get a feel, understand how much you're looking to spend, what is your budget, do you have 20% down, do you have 25%, and just get educated on it. Hopefully this episode's helping, but yeah, lenders can screw you over, and most of them are great people. I'm just saying that
Shop around.
Shop it. Yeah,
Yeah,
totally.
and you'll get a feel for a relationship.
Yeah.
So step 3, submit your property information. So once you get on this step, essentially once you find your deal, you're going to need to get approval of the property from your lender to see if they'll actually lend on it. So you or your real estate agent's going to have to submit the information, and then what that basically is like the purchase and sale agreement. So we just did this.
We just did this, yeah. A lot of it is like they're going to ask for if it's currently rented out, what are those leases? They're going to ask for all the details about the property, and like when it was built, sometimes they talk about like major systems and how new they are, and it's just like understanding the property and is it a good deal for the bank to lend you money on? Like, what's the area like? What's the school system like? And you don't need this all up front for a pre-approval, but it's things that lenders look into, like if they're going to lend you money.
Right. And so once you get it pre-approved, right, and goes through this process here, the step 3, you're going to get a pre-approval letter, and then you take that with you to make your offer.
Yeah, you give that to your real estate agent. Some people don't feel like they need agents. That's great. I think sometimes it's good to not have one if you're educated and you know what you're doing. Oftentimes it's good to have an agent. You give that to your agent, and you need to submit a pre-approval offer with your offer for the property. And we just learned this because we're like, can we make this offer without the pre-approval? And he's like, no, you can't. I'm like, all right, well,
guess we gotta get one. Yeah. Luckily we had a quick turnaround, which is good.
Yeah.
So step 4, the loan goes to underwriting. So when all the information's been gathered, it's up to the lender's underwriter to give the final yes or no on the loan. So you could have the pre-approval and something could happen in the process. Yeah. They make you go through some pretty big hoops.
I don't know a lot about underwriting, but I know that these people are like crunching numbers. That's what they do. Mm-hmm. So it's not about an emotional factor of how nice the house is or what you feel about it or how much you think you can. It's like they just look at the numbers and they give you a yes or no. And oftentimes if you get a pre-approval, you're probably going to get approved. Or they wouldn't have gave you the pre-approval, but sometimes it gets denied.
Yep.
For various reasons.
100%. So. It really does. Step 5, the lender will issue an appraisal. So essentially
at the expense of the buyer.
Yes.
Yeah.
So the lender will hire a residential real estate appraiser to give them the value on the property. So the lender wants to be secure in that their investment to you by lending the money to you will not essentially will not fall through, and that you'll be able to afford it, and it's like a secure deal. Yeah.
Appraisals are weird because like a lot of times they're like it seems like it's preventing somebody from getting a good deal, but then they essentially just want to understand what is the value of the home so that when you go to closing that I guess one party's not getting completely screwed.
And we could have given information and said, okay, this is what it's valued at, here's the rents. And then when they have an official appraiser go through, they're like, what did these guys say? This is not true at all.
Yeah. Appraisals they're interesting to me. Like, I feel like part of it is like, and they talk about this in Bigger Pockets too, like it really depends how that appraiser, what side of the bed they woke up on. Like, I'm not knocking appraisers. I'm just saying, like, if I got one appraiser on a Tuesday and a different one on a Wednesday, they could come in $20,000, $30,000 difference. And it's like, I actually got screwed with an appraiser recently on my refi. I needed to appraise for a certain amount, and maybe my house wasn't clean enough. I don't know. There's, like, all different factors that, like, sometimes it works out and sometimes it doesn't, but my advice for people is just be nice to the appraiser and have a presentable, if you're selling, have a presentable home. That's on the other side.
That's so funny you say that, and it kind of pisses me off now that I think about it. But I had an appraiser coming, and it was before work one day. Basically, I got my schedule mixed up, and I had left 10 minutes prior, and he's like, "Hey, I'm pulling in your driveway." And he was on his pulling in, and my wife had already left for work, and he's like, "Hey, I'm at your house." I'm like, "Oh shit, that was today," and I'm already on the highway cruising down. Like, there's no way I can turn around.
So you were pissed.
And I was like, "Listen, I'm so sorry. Like, I can get you the garage code. You can go in. Blah blah blah." And he was all grumpy about it. And I'll go, sir, I really apologize. If you want to come back another day, you totally can. And he was pissed. He was like,
what do you think he's going to do? Walk in here and give you the best number possible? No shot.
No. It appraised for more, but now I'm thinking I'm definitely got rocked.
You did. I mean, they're human. And that's why, look, I'm not suggesting people pay for 2 appraisals because they're expensive. You can get, a single family appraisals. We have here $400. I think I paid $500 or $600 for an appraisal.
Yep.
Multifamilies, or if it's multiple units, it could be $600-$700 depending upon the area. They're expensive. I'm not suggesting get a bunch, but what I am suggesting is that we're talking about the selling side now, so it's a little bit different.
Step 1, be as nice as possible.
Yeah,
be on time and be there. Don't be a loser like I was.
Because if they walk in and it's dirty, even though it has essentially nothing to do with the value of the property, they're gonna say, I probably wouldn't want to live here.
Yeah,
they're gonna be like, 10,000 off.
I know. I wish I did it after I got this work done. This thing would have been gassed.
Crown molding.
100%. Would have been 15 G's more. All right, but let's talk. No, probably not. Pricing for appraisals, just to give you like a ballpark. Single family appraisals around $400. Small multifamily appraisals can $750 to $1,000, and then a commercial appraisal can be up to $4,000.
I don't know much about that, to be honest, but.
That was just
those high, yeah. I guess
commercials
$4,000 for an appraisal, yeah.
I mean, if you're buying a building, yeah. So okay, step 6, loan goes back to underwriting. So as I mentioned, there's a lot of hoops here, but after the appraisal is complete, the underwriter will once again review all the document and essentially decide whether or not they want to take the risk on lending to you. Step 7, this is the final stage, and this is the best stage, I would say. Mm-hmm. The loan closes. So if the loan's approved, the bank will let you and your agent know, and the title company or attorney will also be informed that your closing is going to go through, and you got to schedule a date, and that's where you sign your life away.
Yeah, it's over. That's it. No, but I mean, a lot of times when you close on a loan, it's 6 to 8 weeks after you offered, and it feels like this long process. My suggestion is just know that it's going to be a long process and don't get stressed out about it, because the banks now, because of the recession in 10, 12, 13 years ago, are doing more of their homework, and they're going to lend to you if they feel like it's a good deal for them. So let them go through the process, because it's in your best interest to have everything laid out properly, especially when we're talking about conventional lending. 100%.
And I was thinking, they're like, did you close? I'm like, what the heck? What are you even talking about? It's really basic. So you literally go to either your title company's or attorney's office. You sit down.
Could be at the real estate,
that's actually where mine was.
Yeah, the real estate
agent's office.
Agent's office, yeah.
Yep. And you sit down and essentially bring a pen. You're going to be there for about, it could be mine was like 2 or 3 hours.
It was just like, what's this? All right, what's that? All right, signing it, and it can be a lot, but
so
that's why you have title insurance and you have a title company that takes care of all
they'll take care of it, and they'll walk you through everything. But either the title company or your attorney will bring a check down for the down payment, or the lender will wire over the funds for purchase. And then once you get through the paperwork, you're the owner of the new property.
Yeah, it's exciting. It's cool. I think that's the finish line for you. But that type of conventional lending is my suggestion for how you'd want to get started in your real estate investing journey, as long as you're putting enough money down and you're not too highly leveraged. And
it teaches you the process, which I really like.
And then the next time you go, you're like, I know what to expect. I know what to do.
We were all worried about lending on our upcoming deals, and I was like, I have a guy I can use, and we were like, great. Yeah, and it worked out. We talked to a couple of different people, but going right back to him just reminded me why I had such a smooth process in the beginning. I'm like, wow, he taught me a lot of stuff. He was willing to sit down.
He was texting us 11 p.m. He's like, I got your pre-approval. We were like, wow.
That day we were like, we need it for tonight. And he goes, all right, got you.
He was sending stuff over. He was like, I could tell he was literally he's like this working 20-hour days.
This is what a 16-hour day will do to you. Yeah. I was like, dude, thank you. I gotta write him a nice review.
Yeah.
So let's talk pros and cons of conventional lending. A couple pros here. I mean, obviously, I like this conventional loans a lot, but they have low interest rates. So most loans are lower than 5%. I mean, if you think about right now,
oh my gosh, we got a crazy rate, below 4% for an investment property, which is
typically
literally unheard of almost. If you're going to go conventional, the rates are just too low to ignore it right now. So
on 30 years. I heard,
on 30-year fixed loans, you can get 2.2% as a owner occupant. 2%. That's crazy.
They're historically low.
They are.
Maybe the lowest ever.
But they're always lower than what we're going to talk about next, which is portfolio lending, hard money lending, private money. They're going to be lower than that, and that's why we suggest it's the best, because they're backed. That's why my suggestion.
They're backed by an institution,
100%.
And they're going to walk you through the process. So, and we talk longer terms. That's huge. You have 30 years to pay it off,
and you can do 15 as well. So we have 30-year conventional, 15-year conventional, and the pros and cons with that really. The only thing I'll say is that when you're first starting out, getting a 30-year loan is essentially going to give you more cash flow. But if you can weather the storm and do a 15-year loan, let's say you buy a rental property when you're 25 years old. It would be pretty sweet to have a paid off one when you're 40, right?
Oh my God.
But I think what the suggestion would be to get a 30-year fixed and have more cash flow coming in so you can buy more deals. And then
you can always refi it down.
And then you can always refinance. Or here's another suggestion. Get a 30-year loan and then do the math on how much it would be if you paid $100 more, $200 more, $300, $400 more into your mortgage each month. That's the reason why I like 30-year loans, because you can always pay more each month and make it a 20-year loan if you want to pay more. There's no prepayment penalty for most of those loans. Where if you're in a 15-year and you're in a bind and something happens at work, you lose your job, you're stuck in that payment each month.
Right. So let's talk cons now. So this is sort of a myth, and we've learned this a couple times over now.
I don't even know if we know what the answer is on this one.
I agree.
Yeah.
We don't specifically know, but apparently it was a rule of thumb that the max number of loans you can get is 10 per investor.
It was 4 originally. People were like, you can't get more than 4 mortgages. And then we were listening to other podcasts, talking to other of our investor friends, and they're like, no, that's not true. You can get 10 to 12. And then
Think about
now
today's
I'm hearing that you can get 100. I think it just depends on your leverage, who you're speaking with, and that's why relationships are so important.
And your what's the debt ratio that we talk about?
Debt to income?
Debt to income ratio.
Yeah, exactly. If you can show that you're making cash flow every month on these properties, banks are still going to want to lend you. So,
So another con here is a slow process. It's not super fast to obtain due to the legal scrutiny and all the hoops that we talked about going through.
6 to 8 weeks to close on a loan.
Property condition. Conventional lenders typically only want to lend on properties that are in good shape. We also talked about the appraisers. And they're not very entity friendly. We talk about the LLCs all the time, and this is where we kind of going back and forth. Like, we've heard many lenders don't want us to lend to LLCs. You essentially could buy under your name, then transfer to your LLC, but then you risk having the due on sale clause, they call it. So essentially this due on sale clause essentially means that if you sell or transfer the property, the bank has the right to call your loan due or foreclose on you right away.
The suggestion with that is just call your bank and ask if they're going to do that. Be like, will you call it? And some banks are like, no, we won't. And others are like, yeah,
we might.
We might. And it's like, all right, then don't do it or you're going to owe your whole loan. So, lending to an LLC, and we're learning this as we go. A lot of times the best way to do it is buy property in your name, run the economics, the cash flow, the expenses through the LLC, build up some equity in the LLC, have a business in the LLC, and then buy your next one in there or transfer it in later. But talk to your lender, because they'll tell you whether or not they're going to call your loan due if you buy one in your personal name and then try to transfer it. Ian, our boy out in Ohio, he said it's like $75 to transfer it. He pays. I'm like,
and then it's like 5% in another state, something crazy.
Yeah, exactly. Or they call your loan.
Dude, we've talked to 4, I would say, heavy hitters, and they all gave us different answers.
Yeah.
So everyone has their own strategy on this, and it can
There's
work
not
for
a
some
straightforward
people.
answer. The
It
point
varies
is,
from state to state too, bank to bank. There's no straightforward answer.
Yeah.
So there you go.
There you go. You have no clue what to
They
do.
have no clue. Yeah. Sorry to walk you in a circle there, but good luck. Do your research. No, but seriously, let's go on to another type of lending here, and it's portfolio lenders. So essentially, a portfolio lender are banks that lend their own money and they don't sell their loans. So most national banks sell their loans to Wall Street, and those loans must meet specific guidelines when sold. So when you go for a portfolio loan, none of the big banks will kind of be in your wheelhouse here. You'll want to focus your search on small local community banks. And typically these banks are, banks that have a maximum of 20 different branches. Credit unions are great for this.
Yep.
I would highly recommend asking them if they do portfolio loans, because you could get a steal.
Yeah. We tried did not work out. Well, I shouldn't say it didn't work out. It just was a lesson learned. We tried to put an offer in for 2 properties, and we were like, can we get a portfolio loan? And the answer was no, because we don't have enough assets, or it was, it has to be above a certain threshold number. Like portfolio loans, like a lot of them start at $500,000. So if you're buying 2 properties for $200,000, and so you're buying $400,000 worth, essentially you might not even qualify for a portfolio loan because it needs to meet this minimum threshold.
Right.
Yeah.
So, due to their flexibility in kind of being with a smaller bank, these loans may be higher in rate and shorter in term, and they might even involve a balloon payment. I believe we've talked balloon payments.
Balloon payments can be scary for some people. I think that, like, again, you go back to managing your finances well, understanding the numbers of your deal. Maybe they're not that scary, and then the balloon payment potentially can pay off your loan. So it all depends where you feel like you're going to be financially at that time of the balloon payment. It's definitely risky, but for some people, maybe it's not. Yeah.
So to break it down, a balloon payment is essentially a due date on a loan that's shorter than the amortized term. Amortized. Come on, man. So for example, say you have a 30-year fixed rate loan, and there's a 10-year balloon on that.
Yeah.
You're going to have to pay the entire balance of the loan off at year 10.
Yep.
Most likely through a refinance.
Yep. And that can work out for a lot of people if they just understand their numbers, what they're running. For me, when we're young in the real estate game, people think it's a little bit scary because we like fixed 30-year or a fixed 15-year. That way you know what you're paying every year, as opposed to having a big balloon payment. But when you go into private lending, which is what we're going to talk about next, and hard money lending, a lot of times those people want their money quicker, and
it's going to have a higher rate.
And it's going to have a higher rate, and balloon payments are going to be involved. Right. A lot of times.
Let's talk real quick the deal that we had that had a balloon payment.
All right, so we had, let's just say, a $60,000. Oh no, it wasn't. It was a $40,000 property, a very cheap. Well, I wouldn't say very cheap, but
economically friendly.
It was a cheap property, $40,000, and essentially the property owner was going to seller finance it. All right, so in other words, the property owner, the current owner, the seller, was going to be the bank. So what he wanted to do on the property is said, you guys can put 10% down, and on $40,000, we're talking about $4,000. So we're looking at that like that's not a lot of money up front.
Yep.
The property may have other repairs, but you talk about your $4,000 up front, then you pay some closing costs depending upon $2,000 to $5,000, whatever that is. So you could be all in for like $7,000 at the beginning. Then they amortize the loan. He wanted to amortize the loan over a 30-year amortization, but have that be a 3-year balloon payment. So in other words, or maybe it was a 15-year amortization,
I know he wanted
3-year balloon
8%.
payment. Yeah, at 8%. So essentially what he's saying is that he wants us to pay 8% of an 8% APR for a 3-year term, and then at the end of those 3 years, we owe him the balance of the term. So let's just do these easy numbers with $40,000. You put $4,000 down on $40,000. You have $36,000 loan that the seller's carrying. Then you make your payments for 3 years at the 8%. Let's say you have $31,000 left, and then that's at that 3-year balloon payment. It's due after the 3 years. With something that small, it could potentially be worth it for you if you know you're going to build some cash flow up, if you're going to try to refinance out of it later, if you put some money into the deal and then you can refinance it and pull all your money back out. But that's seller financing is another type of almost like a type of private lending.
It is.
Yeah.
I mean, we can dive into it right now. Seller financing essentially is a real estate agreement in which the seller acts as the bank, as you said. They handle the mortgage process rather than going through a financial institution. So instead of applying for a conventional bank mortgage, the buyer signs a mortgage with the seller. This is also known as owner financing. So you kind of crushed it right there. We talked about a bunch of different types within that. Within that one example. So let's bump back here and just talk private lending. So private lending, it's kind of is what it sounds like. It's the process of borrowing money from private individuals rather than from institutional lenders such as a bank. It's sometimes referred to as relationship lending because you're essentially borrowing money from pretty much any person anywhere as long as that entity is not a bank and it's private. It's on side.
Yeah, so private money, oftentimes the reasons why people don't do it right out of the gate is because it's more expensive money. And when I say more expensive money, it's just like a lot of private lenders are not going to give you 4 or 5%. A lot of private lending can be between 8 and 12% or even higher. So oftentimes they want their money back quicker, and those where those balloon payments go into. We've never done private lending. So like we'd love to bring somebody on who does it. Either does the lending or gets their money from private money lenders. Oftentimes with private money and hard money, they're really good for BRRRR. Like when you buy, rehab, rent, refinance, and then repeat it, because these private money lenders want their money back. So you can essentially you get the full amount of the money from the private money lender. You owe him that 8 to 12%, and then you pay him off, and then you refinance into a conventional.
Right.
So that's one of the ways to do it.
Right, and you kind of almost like a hybrid here, but jumping into hard money lending. So very, very similar to private lending, a hard money lender is a professional lender who lends their own money or other people's money for a living. So they have a set way of doing things, a predefined interest rate, a predefined set of fees, and a very short term, as you mentioned, usually less than a year, that they want their money back. So, private lending essentially could be a family member that just is willing to lend you the money privately, whereas the hard money lender is a professional that does it on a daily basis.
Right.
Cool. Another cool one, which I love and appreciate if you dive in here, is home equity. So essentially what you can do is if you own your own home or a specific property, you may be able to use some of the equity you have in that property to purchase additional rentals. So just as kind of a reminder, equity in a property, or your equity, is the spread between what is owed on the property and what the property could sell for. So for example, let's say you owe $60,000 on your primary residence, but you could sell it for $200,000. You have $140,000 in equity on that property. So that equity can be borrowed against a very low interest rate, or through a home equity loan or home equity line of credit. I hear HELOC all the time, this acronym HELOC. That is what this is. It's a home equity line of credit where essentially you're pulling the equity out of your home to purchase another property.
Yeah, and it's a really good way. Like, let's say if you've owned a home for 15 years and you want to pull money out to go buy a deal, you don't realize that you may or may not realize that you've been paying down your loan over this extended period of time. And like you said, to use those numbers, like let's say you have a $200,000 home, you've owned it for 15, 17 years, you probably only have $120,000 or $100,000 left on the loan, and you have that equity, and maybe the $200,000 is what it cost when you purchased it. It might have also appreciated, and it might be worth $275,000, in which you have, in that case, $175,000 of equity, and then you can refinance, pull your money back out at somewhere around a 70, 80, sometimes even 85, 90% loan to value ratio.
That's what I love when we talked about, it's 20 to 25% down on an investment property. I don't look at that as a bad thing, because you have equity in the property the day you buy it, which is amazing, and you could take it out down the line.
What are you talking about, putting that percentage down? Yeah, it's just not liquid cash, but I agree with you.
But you're not throwing it in the trash. No. That's your leverage. You're using it again.
Yeah, exactly. That's why people save up for a down payment, and you're essentially your worst case scenario by putting 20% down or putting more money than you want to down. It's locked up in the property, but it's still in your net worth.
Right. It's not like you're spending $25,000 on
a car
or a vacation that's going away.
Exactly.
So $15,000 on a vacation, or you put $15,000 in your house. Okay, you can get the $15,000 back from the house.
Exactly. Or a car too, which is a depreciating asset. Not only do you not, what's the say? I mean, it's similar, but
I hate the car thing. It sucks, dude. Because cars are awesome, right? And you're in it a lot to drive to and from work, and it sucks that the day you buy it and drive it off the lot, it depreciates in value.
Yeah, I think that's why we talk so much about, like, we're kind of car guys and we love having nice cars, but I'm so cool with having that delayed gratification and waiting to buy a really nice car until my properties have enough cash flow to pay for it. That's the whole game that we're trying to play here.
And the thing is that we're not just talking about this. We both have lived this. We both have purchased spent a stupid amount of money on nice cars. They're amazing. You feel great. You get jacked every time you see them. You feel like beast driving.
I sold it.
Yeah, then you sold it. But then you're like, I don't really care anymore. At
Yeah.
some point, it hits you where you're like, wow, I could be investing this in property and making money as opposed to just having it spill down the highway.
Yeah, literally.
Literally. So, that's our take on that.
Yeah, that's our rant.
So let's go. A couple more here. Partnerships. Juice boys, come on, let's go. So
Partnerships are cool because it mitigates your risk, right? And
Yes.
Oftentimes partnerships are done at a 50-50 clip, like where you not only split the mortgage payments and all those expenses, but then you split the cash flow. Everything is done 50-50. You might have a managing partner, somebody who manages the rental versus somebody who does operational, like budgeting and running books and numbers and stuff. And that's something that you'd have to work out with a partnership. But a partnership is a great way to mitigate your risk going in up front, where you're responsible for half of the asset. And we just dove down this, it's gonna be really good. But you just have to make sure that you and your partner are on the same page of things, right? You don't want to partner up with someone who's, I want to build a $1 billion company, and the other person wants to just get 15 rentals or 10 rentals and be financially free, and like you'll go in different directions at certain points. So
you're gonna grow apart, right?
Yeah.
Like you gotta. And it's hard to say where you want to be in the next 20 years, but it's a normal thing to have that goal up front and talk to your partner and say, and that way you figure out, is this the right guy or girl for me in this deal or no? So I love the partnership deal. If you think about it's just basic numbers here, but if you need $50,000 down on a property, I think on a $200,000 house, about $50,000 you need down for a rental.
Well, it depends what you mean for
Investment property, sorry.
Yeah, so I think it's $40,000 is 20%.
Okay,
Yeah.
so that's just say instead of me going out of pocket $40,000, I go in with you. We split it 20
each, yeah.
and then we split. You have an operating agreement, which you have written up, and essentially it dictates the terms of like who's responsible for what, as you already explained.
Yeah.
So it just mitigates the risk. I think it's awesome, especially when
Partnerships are cool
starting out.
because then you not only have what we just talked about, but the idea and the ability to bounce ideas off each other and to
share the excitement.
Yeah, exactly. So we like partnerships, obviously, because we just formed one, but
It
we'll
holds
let you know how it goes in 5 years.
Yeah, well, but I just love the accountability, right? You don't want to let the other guy down, and whatever. I can't say enough about it. Love it.
Yeah.
So seller financing, you touched on this briefly, but essentially, we already did this. We already talked about seller financing, and we talked house hacking. So those are my last two that I wanted to cover.
I think that there's a lot of ways to look at funding deals, and there are a lot of creative ways where no money down, where you find the deal, you kind of bird dog the deal, and then you borrow somebody else's money. They're the financing guy, and then you can get into deals with no money down. But like they say oftentimes on other podcasts and real estate books, no money down does not mean I have no money, right? Like it just means that you can purchase a property without putting any of your money into it, but you still have the reserves should something go wrong, right? So there's other creative ways to finance deals, and we'd love people to reach out to us and give us their stories about how they finance deals, because like we said, this isn't gospel. This is just some information for people and to talk about some of the ways that we're doing things. And we'd love to hear the way you're doing things, because there's always great ways to finance deals, which brings us to The Last Drop, right? And The Last Drop's a really good book. I actually haven't even read the book.
So I dove in here, haven't finished it completely, but so far it's amazing. It's called Finding and Funding Great Deals, the Hands-On Guide to Acquiring Real Estate in Any Market by Anson Young, published by none other than Bigger Pockets, who we love. So that's The Last Drop for today. My shout out to The Last Drop.
Show him.
Oh, show him. I think I said shut up.
Oh, yeah.
There you go. Here's the book cover. Awesome book. And it's just
read
kind of most of it.
Yeah.
So basically it goes into literally, like it says, finding and funding deals. So it talks about where to research deals on and off market. Then it goes into all the different types of lending we talked about. And just it gives a nice hands-on approach with stories. It's an easy read, put it that way. So that's the Last Drop this week.
Cool. This was like one of those educational episodes for people. Like we said, we love to hear from you on the ways that you've funded and financed deals. We always like to, find new creative ways to do it, because that's the game, and we love the game. So I think that's what we got for today.
That's what we got. That was some knowledge. That was another episode on the educational series here. So.
Episode 17. Like us on or follow us on Instagram at Weekly Juice Pod. Subscribe to us on YouTube. Leave a review. Reviews are awesome for us. They kind of push us up in the rankings, get more people to listen in and
if you like what you're hearing.
Yeah.
If not,
or give us a 1 star if you hate it, or maybe not.
Yeah, just leave it.
But hopefully you like it, and we'll keep bringing it to you.
And honestly, please share some feedback here. Send us a DM if there's some topics you want to cover. We already talked about student loans. We had 5 people reach out, so that's why we got on Lauren Williams in one of the previous episodes. We are willing to take your feedback essentially and implement it. We want to appease the audience here.
Yep, we have some cool episodes coming up, so stay tuned, people.
Stay tuned. Juice Boys out.